space, Nvidia, AMD, Micron, you name it, there's strength. Nvidia this morning up more than 1% in the pre-market, hit another record itself. AMD is higher in the pre-market. Micron gaining more ground after that big almost 9% move yesterday. What's your take here, KG?
Yeah, once again, a lot of news headlines kind of hitting the tape, so we'll kind of go one by one. We did actually see Taiwan rejecting this 50-50 split of chip production with the United States. This proposal, it's a high-level proposal, but it seems like they are against that measure at this point in time. And this kind of coincides with the fact that Intel continues to try to find new deals and new buyers, new investors within their company in order to expand their foundry business here in the United States. We already know about the Nvidia deal with Intel. It seems like from Semaphore, which is reporting this, that AMD could potentially be in talks with Intel in order to try to change or even diversify their production mix here. And this pressure that we have seen from the White House, especially in the chip space, seems to be working at this point in time. And that's where you are seeing these bids being caught into these stocks. You also have the memory names, the SanDisk of the world. You also have Micron, Western Digital. A lot of those stocks kind of did not really participate as aggressively within the whole run-up to the AI rally here. But now the market is starting to recognize that you need more memory in order to expand your inference capabilities here. And so a lot of those stocks, once again, some of them very low price, maybe a little bit low float, are catching a bid and moving these stocks higher. So the tailwinds of the AI boom continues to stay into effect. The chip space continues to get a lot of love here. You're also seeing that translate into the utility names as well. I mean, Diane, and we're at this point in time now where the power names and the utility names are acting as a risk-on asset rather than a risk-off defensive asset because of the fact that we do need more power. So as long as we actually have that thematic trend continue here, it's going to be very hard to kind of break this market down until we start seeing some cracks within this industry, maybe overcapacity. Right now, it doesn't seem like any analyst or any market participant right now is projecting that that's going to happen over the next 3 to 6 months.
The market is dominated by Nvidia. Data center capital expenditures are expected to exceed $3 trillion to $4 trillion by 2030, according to management's projections. If you purchased Nvidia in the beginning of 2023, you are really pleased. Since then, the stock has increased by over 100%, making for an incredible return in a short period of time. Investors who believed it was too late to purchase, however, might be forgiven following a run such as that. Price anchoring is the process by which your mind fixes itself on the previous stock price, leading you to believe that you've missed the opportunity. However, visualizing its direction is a more acceptable way of thinking. If you can do that with Nvidia's stock, it's evident that the company has a long runway for growth and that it still has a lot of momentum to continue after its disastrous run. The preferred semiconductors for processing and training artificial intelligence, AI models, are graphics processing units, GPUs, which are manufactured by Nvidia. Because GPUs can do several calculations simultaneously, they are perfect for tasks like artificial intelligence that demand a lot of processing capacity. Although there are a few rivals in this sector, Nvidia is the clear favorite with a 90% market share in the data center industry. The company's largest clients are collaborating closely with it to guarantee that there are enough GPUs available for them to outfit their data centers after construction is finished because of its strong market share and the present supply shortage. Investors should therefore pay attention when management makes audacious predictions regarding the industry's future. Nvidia anticipates that worldwide data center capital expenditures will total $600 billion this year. It is anticipated that amount will rise to between $3 trillion and $4 trillion by 2030. That's incredible growth, and if it continues, the business will obviously have more space to grow. The fact is that the chip maker has more knowledge than anybody else in the business due to its tight relationships with its clients, even though I believe that such large estimates should be viewed with some suspicion. Even after its impressive run, Nvidia is still a compelling company to think about purchasing now because even if the forecasts are off on the overall amount, they are probably right on the overall direction. The stock doesn't appear inexpensive at its current pricing. It is at the upper half of the range it has traded at over the last 3 years, at 40 times anticipated earnings. It is maintaining quite close to its historical statistics, though, since it is about in line with its level at this time last year. This will actually be a very little price to pay if Nvidia's market projections come to pass, as revenue might more than triple over the next 5 years. However, This could out to be excessively costly, making AI a bad investment if expenditure doesn't end up anywhere close to where management projects. Given Nvidia's history of success and all of the recent spending announcements, I would think the likelihood of this occurring is minimal. Since the market typically doubles every 7 years, if Nvidia's revenue growth is in line with its stock growth, it is a good investment right now because, should demand prove to be as robust as management anticipates, it will probably exceed the market. AI infrastructure is seeing a huge influx of funding, and Nvidia is the company with the biggest share of this market. Because of this, investing in it now is a no-brainer, and years from now, investors should be pleased that they paid today's price. With the capacity to scale buildings and power being the major limitations, Bank of America analysts stated they are still optimistic about artificial intelligence capital spending and predict yearly investments would nearly quadruple between CY 2530E to over 1.2 TM+. The company identified 4 primary factors that contributed to the rise: upgrading traditional infrastructure to faster processing, preventing OpenAI, XAI, and neoclouds from upending established moats in search, social media, e-commerce, and cloud services, implementing sovereign build-outs, and steadily implementing AI productivity tools in businesses. According to BofA, the current build-out of AI infrastructure is more resilient than previous cycles because it is financed by robust cash flows from government buyers and hyperscalers. The top 5 U.S. cloud providers alone will spend capital expenditures equal to 25% of CY25 sales, which will be well covered by 30% plus operating cash flows. Additionally, adoption of AI can occur without the need for expensive upgrades to consumer devices. With an increase of plus 58% plus 19% YoY from plus 54% plus 16% previously, the bank's cloud capital expenditure tracker now shows $443.528 billion in capital expenditures from leading public cloud providers. By CY30E, at present levels of 25-30% capex intensity, capex could triple to 1.2 TM+. Chip makers including Nvidia, Broadcom, AMD, Marvell, Credo, and suppliers of semiconductor equipment like Lam Research and KLA were mentioned as being in a strong position. Regarding worries about vendor funding, BofA stated that Nvidia's $100 billion pledge to OpenAI should not be seen as free money, GPUs, but rather as a force multiplier that encourages further investment in hyperscalers. According to the Wall Street consensus, Palantir's stock will drop 15% over the next year, while Nvidia's stock will rise 15%. Because of its unmatched software development platform and rack-scale data center technologies, Nvidia is the industry standard for artificial intelligence infrastructure. Despite being a well-known leader in AI technologies, Palantir has the questionable distinction of being the most expensive stock in the S&P P500 by a significant margin. In January 2023, the craze for artificial intelligence, AI, really got going. Since then, shares of Palantir Technologies have increased 2,810%, while those of Nvidia have increased 1,090%. According to Wall Street consensus, investors should think about selling Palantir, but can still purchase Nvidia. Nvidia has an average target price of $218 per share among 66 analysts. From its current share price of $180, that is a 15% increase. Palantir Technologies has an average target price of $157 per share across 29 analysts. Compared to its current share price of $185, that is a 15% decline. Investors should be aware of the following information regarding Palantir and Nvidia. Nvidia's position as the industry standard for AI infrastructure is the foundation of its investment case. Although the firm is most recognized for its graphics processing units, GPUs, commonly referred to as AI accelerators, it really creates rack-scale systems that include GPUs, CPUs, networking hardware, and interconnects in order to offer a turnkey solution for data centers. Crucially, NVIDIA GPUs are likely to continue to dominate the AI accelerator market because of their CUDA programming model, an unmatched ecosystem of software tools that support application development across use cases ranging from recommender systems to robotics, even though a number of companies are working with Broadcom and Marvell to develop custom AI chips. The CUDA software platform provides NVIDIA with a impenetrable moat, according to Beth Kindig, a technology analyst with the IO Fund. In a similar vein, John Vin, an analyst at KeyBank, stated, "We see limited competitive risks and expect Nvidia to continue to dominate the market for AI accelerators because to the substantial obstacles to entry provided by its CUDA software stack." Over the next 3 years, Wall Street anticipates a 36% annual growth in Nvidia's earnings. Because of this, the present valuation of 54 times earnings appears to be fair. If investors are able to withstand volatility, they should feel at ease purchasing a small position today. Since coming public in 1999, Nvidia has lost at least half of its value 7 times. Palantir's position as the up-and-coming leader in AI software is the main argument for investing. Its AI platform enables users to integrate large language models, LLMs, into business processes and applications, while its core data analytics platforms assist government organizations and commercial enterprises in managing and making sense of complicated data. Palantir's distinctive software architecture has helped it stand out. In order to facilitate decision-making, its systems are based on an ontology, a framework that establishes the connections between digital data points and physical assets. In order to generate a feedback loop that gradually enhances insights, the ontology furthermore records operational outcomes. Palantir's ontology-based software gives the company a distinct moat and a significant advantage over its rivals, CTO Shyam Sankar recently told analysts. In fact, Palantir was recently named the technical leader in AI and machine learning platforms by Forrester Research, which gave the company higher ratings than Microsoft, Amazon, and Alphabet. Due mostly to the constant demand for its AI platform, Palantir has posted rapid sales growth for 8 consecutive quarters. Additionally, the business is in a strong position to keep up its momentum. According to Grandview Research, the increased use of AI tools will propel a 29% yearly growth in spending on data analytics software until 2030. Palantir, however, has a significant value issue. Few software firms have ever attained the valuation of the stock, which is currently trading at 137 times sales. For comparison, AppLovin, which is 43 times sales, is the next closest S&P 500 stock. This implies that even if Palantir's share price fell by 65%, it would still be the most expensive company in the index. On Friday, U.S. technology giant Nvidia and Japanese computer and telecom manufacturer Fujitsu decided to collaborate on artificial intelligence in order to produce smart robots and other breakthroughs utilizing Nvidia's computer chips. Already, the industrial revolution in AI has begun. As he hugged his Fujitsu counterpart Takahito Tokita on stage, Nvidia CEO Jensen Huang stated that it is crucial to build the infrastructure to power it in Japan and globally. Huang told reporters at a Tokyo hotel that Japan can set the global standard for robots and artificial intelligence. The businesses will collaborate to construct what they have dubbed an AI infrastructure, or the framework that will serve as the foundation for the numerous futuristic applications of AI in fields such as manufacturing, healthcare, the environment, next-generation computing, and customer service. By 2030, it is hoped that Japan will have that AI infrastructure in place. According to both parties, it will be initially designed for the Japanese market, utilizing Fujitsu's decades of experience in this country, but it may eventually go global. It will make use of Nvidia's GPUs, or graphics processing units, which are crucial for artificial intelligence. The two executives did not provide a budget for anticipated investments or a list of specific projects. However, one potential example was looking into a partnership in AI for robots with Yaskawa Electric Corp., a Japanese manufacturer of robots and machines. According to them, AI will continue to develop and learn. In an effort to address Japan's labor shortfall as it ages, Fujitsu and Nvidia have been collaborating on AI to accelerate production using digital twins and robotics. According to Takeda, the businesses were adopting a human-centric strategy to maintain Japan's competitiveness. We hope to develop new, unheard-of technologies and help address even more pressing social concerns through our partnership with Nvidia, Takeda stated. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Let's talk a little bit about where we stand with the S&P 500 KG. So, look, we finished above 6,700 yesterday, so solidly closing above that. And it's a level that some analysts had as their target for the end of the year for the S&P 500. So we've blown past that. We'll probably see some, new targets once again. What's your take on one, I guess the levels that you're watching today to the upside and the downside? And, are you expecting to hold that level above 6,700?
Yeah, so if you're kind of looking at the options flow early this morning, you're looking at the upside potential resistance area where we do see some calls being sold. Basically, there's kind of a call spread or a condor trade that's been placed out there right now. The upside, 67.45 to the downside, 66.80. Diane, we can kind of talk about some of the intricacies of this market, but at the end of the day, technically speaking, higher highs, higher lows represents a trend to the upside, so you got to keep that simple. Right now, the news flow is not impacting this market negatively at the moment. And in fact, the embargo, if you will, of economic data because of the shutdown actually could be a tailwind for these markets. I mean, if we don't get the BLS data on Friday, can we confirm what ADP reported yesterday? If we do not get initial claims today, can we also confirm weakness in the labor market? We really can't. So we're flying blind, and the market's really kind of focusing back on these market trends, if you will, and less relying on the macro data, at least for now. That might not be the right thing to do, but the trend says higher when you're looking at the technicals, and right now you got to go with what the market's kind of feeling and make sure that you have downside protection when necessary.